Great day. Today we're going to discuss the differences between a Roth IRA and an uninterrupted compounding interest account, better known as a permanent life insurance policy. So only earned income can be contributed to a Roth individual retirement account. In 2023, you can contribute up to $6,500 to a Roth IRA. In 2022, you could only contribute up to $6,000. They upped it due to inflation and what's going on in the world today. If you are 50 or older, they recognize that you need to put in more money in order to have that money working for you. So if you're 50 years or older for 2023, you can put up to $7,500, up from $6,500. So that's one of the drawbacks with a Roth IRA account, is the fact that you're limited on the amount that you could put into it to get it working for you. Now, as far as the IRA itself goes, it is a variable product, meaning it goes up, but it also goes down. So you are vulnerable to the market corrections. And every time the market does a correction and you experience a loss, well, you have to more than double that in order to rebound and get out from under, back from where you were, to start capitalizing on some gains again. So you have to ask yourself one question. Do I want the money that I've worked hard for to be able to retire with susceptible to those market losses? Also, a downturn with a Roth account is you can only make so much money per year. For instance, you're limited if it's 2023 to less than $153,000 if you're a single tax filer, but if you're married, you can only make up to $228,000 for the year. Now, there is an alternative out there, and that's what we're here to discuss today, is the uninterrupted compound interest strategy. And what that is it's something known as the rich man's Roth. It's a properly structured, designed, and engineered permanent life insurance product, but it is not designed for you to use after you die. It's designed for you to use while you're still living. Now, there is no limitations on the amount of money that you make. So you could make $1 million a year, you can make $2 million a year. It does not matter. Also, the way that these policies are structured, that's why we always say it has to be properly structured, designed, and engineered, is because we structure as agents these types of policies based on how much you'd like to save or how much would you be able to comfortably save into one of these per month or per year without putting yourself or your family in any kind of financial hardship or financial burden. You're also able to, as it is structured, overfund or do what's called max funding your policy, and that gains you access to that money sooner. And by the way, it is 100% income tax free on the amount of money that you use from the policy, because you are not withdrawing your money. You're using a different type of strategy, because if you withdrew your money, you would be taxed on capital gains tax. So in the book Rich Dad, Poor Dad by Robert Kiyosaki, he tells you that you're not taxed on debt. Essentially, what you're doing with these types of policies is you're using a strategy known as infinite banking. You're becoming your own bank over time. Most people don't have a lot of capital they can invest into one of these, for instance, $100,000, $200,000, $500,000, unless they have an old 401k that they can use without being penalized to max fund or do an initial upfront contribution on one of these things to get it started. Most people are using these on a monthly basis, and they're putting into it either $200, $300, $500, $1,000 a month and building it up over time. Now, that money is going to compound annually. It's never going to be at risk of any of the losses, and the gains that you experience annually are going to be locked in for the next year. So you're never going to have any worry about your principal disappearing with the market. This is why these types of strategies people are starting to use as a form of college savings for their kids. They're also starting to use as different retirement diversification tools as something called a life insurance retirement plan. Because this is one of the only financial tools available to you that guarantees you a tax-free retirement and never being susceptible to market losses, while also being able to pass down a legacy income tax-free down to the rest of your family. If you'd like to learn more about the differences between a Roth account a traditional retirement account, or a index universal life permanent life insurance policy, and you'd like to look at seeing what one would look like specifically for you as a life insurance retirement plan, or as a way for you to build capital and invest in other things like business startups or other assets, or you'd like to look at getting one started for your kids or grandkids in the form of a college savings or capital that they can use to start their own businesses, make sure you click the link in the bio today and schedule your free consultation.